according to this article, rate hike seems unlikely. I don't think rates are high enough, people, to hedge against what's going on right now. I don't think rates are anywhere near where they should be. Canadian economy grew 0.5% in April when harsh weather weighed on the GDP. Okay, the May reading was 2 notches above the consensus expectation for a 0.3% increase, according to the economists polled by Bloomberg. So there's a little video here. I'm not sure if I should play this. It's just variable and fixed rate. What the interest rate hike means for your mortgage. So what they're trying to do, I guess, what the media is trying to swing here, is they're trying to swing away where, hey, you know, maybe we won't raise interest rates now for you guys. You know, and then now putting up this video, let's watch it. Let's see how long it is. There's a bunch of music here. I don't want to get flagged.
Interest rates once again on Wednesday. It was the 4th hike in the span of 12 months. The central bank's trend-setting policy rate now stands at 1.5%, up from just 0.5% last July. In this edition of our Money 123 series with Erica Alini, we're asking, how will this latest rate increase affect Canadians? Erica, what do borrowers and savers need to know?
Robin, at first glance, the implications of higher interest rates are pretty simple. It's bad news for borrowers and good news for savers. But there are other factors that savvy consumers should keep in mind. Let's start with what happens when interest rates go up. Variable rates on mortgages and lines of credit go up as well. So what does this mean for borrowers? Let's look at mortgages first. Despite the string of interest rate hikes we've seen, mortgage brokers I've spoken with are starting to argue in favor of variable rate mortgages for borrowers who have the flexibility to absorb additional rate hikes. The spread between fixed and variable interest rates on new mortgages has been widening, meaning that borrowers are paying an increasingly high premium for the security of a fixed rate. If you have a line of credit with a floating rate, there really isn't a silver lining, unfortunately. Borrowing costs are going up, period. But a home equity line of credit, or HELOC, still looks like a pretty good way to finance a home renovation. And that's because, like a credit card and unlike a loan, it allows homeowners to borrow as they go. That flexibility is handy during a reno where people might go over budget. But as interest rates keep rising, once borrowing for the reno is over, homeowners might want to turn that home equity line of credit into a fixed rate loan. And what does it mean for savers? Well, that's a different story. The interest rates that banks pay on investments like guaranteed investment certificates, or GICs, don't move in tandem with the Bank of Canada's rate. Usually, there's a lag of a few weeks before GIC rates rise, and the banks won't necessarily bump those rates up as much as the Bank of Canada rate. In fact, they might not adjust GIC rates at all. Savers should also keep in mind that the interest rate you can earn with a simple savings account at some of Canada's online banks and credit unions right now can be higher than what you can get by parking your money for 5 years in a GIC at some of the big banks. So if you're thinking of investing in a GIC, maybe wait a few weeks to see if lenders start offering higher rates. If you're in the market for a home or renewing your mortgage, maybe take a close look at variable rate mortgages. And if you're using
All right, that was that. That gave you an explanation. So if you're on like a line of credits and you got credit cards with revolving debt and you're paying a blended rate and stuff like that, what happens usually is rates go up on everything. So rates will go up on those credit cards, lines of credit, and none of that stuff is secured, right? Because it's always unsecured, right? And anything can go any way, you know what I'm saying? Okay, lots of people commenting in the comment section here. I'll get to your comments in a second. Let's continue reading. 19 out of 20 sectors tracked by Statistics Canada recorded a pickup in economic activity. I don't know where this economic activity pickup is coming from. So, according to this article, if you're just tuning in, Canadian economy grew 0.5% in May, prompting talk of fall rate hike. So they want to cancel the fall rate hike, which is damaging to the economy if they don't raise rates. It's very damaging. And like the article I read before, the black swan will come in And boom. Although the energy sector disruptions like production shutdowns in Alberta's Syncrude plant are expected to weigh on the June GDP figures, the economy is on track for a strong second quarter growth that the Bank of Canada expected. CIBC chief economist Avery Sheffield noted shortly after the release. Barring the bad news on the NAFTA or auto tariff front, the Bank of Canada will be raising rates in October, which is now our call. So that's that with that. Is Canada. So let's tie in this article here. Canada's economy rebounds, but imminent rate hike seems unlikely. So they're looking at not wanting to raise rates now. This is going to be a lot more damaging, and it's going to be a lot more of a nightmare coming forward in the future. It's just going to prolong the problem. So Ottawa, Canada's economy rebounded in May after a series of challenges in April, but analysts played down the chances of intermittent rate hike, saying the Bank of Canada already predicted strong second quarter growth. Statistics Canada said on Tuesday that GDP grew. I read that part. The retail sector expanded 2%, while the construction posted 0.7% gain.